Hello, you guys. Today we're going to be doing section 3.5 of IB Business Management, which is basically on profitability and liquidity ratio analysis. So let us begin with this video. So key points about ratio analysis. So what is ratio analysis? It's basically a financial analysis tool. So it's a tool for analyzing finance. So the numbers you have. So basically, it's used in the interpretation and assessment of a firm's financial statement. So basically, like we did financial accounts, final accounts in section 3.4, the video's already up, you guys, if you want to watch that, or if you want to watch it after, but I recommend you watch it before, definitely. But basically, it helps you analyze whatever financial data you have. It helps in evaluating a firm's financial performance by determining certain trends, so certain trends it may detect, and strengths and weaknesses. Okay, so it determines two things. You can take it as an abbreviation of CS, so certain trends, strengths, and weaknesses. It's in decision making by making meaningful historical inter-firm comparisons. So basically, if you have a file from the year 2001 till 2024, right? So basically, you end up just comparing in these 23 years you have, and you see you use this historical data to make comparisons because you can analyze past ratios in other businesses in the same or different industries. So basically what you can do is you can also analyze using these ratios other businesses, especially if they're in your industry. It can be your industry or other industries, but you can just compare how well you're financially doing to your competitors, seeing how well they're doing with the amount they're selling, the differences, how you can improve, how you can do better, basically, as a firm. So the first type of ratios we have are profitability ratios. So profitability ratios, they assess the performance of a firm based on its profit generating ability. So basically how much profit it generates, right? So the types of profitability ratios we have, the first one is gross profit margin. So basically we have to know how to calculate it first and foremost. So basically it's gross profit divided by sales revenue times 100. When you have to multiply by 100 the formula, this means that your answer always has to be in percentage. If you don't write the percentage, this will actually make the examiner remove you some points just because you didn't put the unit and the unit is needed. Most examiners, if not all of them, will remove on the unit. So make sure you have to write your units. I'm just gonna put this here. Always write the unit, okay? Always keep that in mind, you guys, right? So basically, what are some strategies that you can use to improve your profit margin? The first thing you can do is a firm can increase prices in the market where there is little competition. So basically, little competition, less substitutes, and less sensitivity changes in prices. I'm gonna be explaining this thoroughly, but I want to explain one thing first. So basically, sales revenue, it's equivalent to price times quantity, right? So basically, when price increases, so does sales revenue, okay? But the thing is, the catch is, you have to make sure that quantity remains the same, okay? So how can you do that? So what you end up doing is that you have to make sure that you have to make sure three things. There's little competition, meaning that there's no other firms, no or little other competing firms, meaning they offer the same good or service, meaning product, whatever. So basically, you have to keep. So basically, if you're an economic students, this will quite be more easy for you, or just be more familiar with it, because this really has to do with price elasticity of demand. But we're not going to get into that because this is actually we can get into this. This is part of the IB Business Management syllabus. So basically, I'm just gonna slightly explain what PED is here. So basically, PED is basically the proportionality between change in price and demand. Okay. Now I'm gonna be explaining this more thoroughly. When a good is price elastic, it means the change in price is proportionate to change in demand. However, if it's price inelastic, the change in price is non-proportionate to change in demand. Meaning that if price increases, demand does not change, in this case specifically. Okay. This means that the consumers or customers are less sensitive to changes in price. Okay, so less substitutes, meaning that, for example, this happens a lot in the pharmaceutical industry because pharmaceutical products are price inelastic because people need them. Okay, people need people need these products, so they're gonna pay for them no matter what. Because, for example, like insulin is needed. It has a very low price elasticity. So let's say I'm gonna give you example insulin. There's nothing else you can replace for insulin, right? There is maybe zero substitutes, so there's less substitutes, so the customers have to pay, and less sensitivity to changing the price. Maybe that is like, for example, a good like salt. Let's say salt costs $1. If they make it 1.50 cents, I don't think that's gonna change how much people end up buying it, even though there's like a 50% price increase. But they're still going to buy it. Okay. So what will happen? So this will increase sales revenue. Why? Since price is increasing, like I previously explained, and the quantity purchased won't be altered, but there is still a downside. This could harm the brand image to loyal customers, so harm the brand image, or perceive it as a way of charging them too much in order to make higher profits, so charging them too much, okay? And always remember in IB business management, you have to give your advantage and disadvantage. So basically, you always have to show both sides of the coin. So you have to say the advantage and you have to say however or yet. So you always have to show two sides. You have to show the two perspectives or else you won't get both points. Keep that in mind. Always keep that in mind. You always have to write both perspectives. A business can source cheaper suppliers to cut down on its purchase cost, meaning that basically their variable cost or cost of goods sold. This will reduce cost of sales, so it will end up reducing cost of sales and increase the gross profit margin. Okay, why? Because they're going to be making higher gross profit. But because keep in mind that basically gross profit is equal to sales revenue minus cost of goods sold. Okay, meaning that a decrease in cost, meaning that a decrease in cost of goods sold will cause an increase in gross profit. Okay, this is how it really works. So this will end up increasing the gross profit margin, so basically an increase in gross profit margin will cause an increase in gross profit will cause an increase in gross profit margin. Okay, however, the business should ensure that they do not compromise the quality of their products, which may cause customer resentment, right? So basically, let's say you're buying a shampoo from a company that like a company that produces shampoo, right? And you see that the quality of the shampoo is deteriorating. It's not really giving the same effect it used to give to your hair. It's not giving the same benefits, it's not making your hair smell as nice. So basically, what will happen is that you will feel customer resentment. You will feel customer resentment because you'll be like, oh, okay, so basically I'm not getting the worth of my money. So I'm no longer gonna buy this from this brand because they're trying to save money by using cheap ingredients, right? So I don't wanna buy from this brand. So this is what will happen. So this customer resentment will cause a jeopardizing. So they will jeopardize brand image and brand loyalty. Okay. So this will actually have a counter effect on the business. So there will be a counter effect because this, as sales revenue may decrease, since this will cause a decrease in quantity, right? Okay, this will cause a decrease in quantity purchased. Decrease in quantity purchased will cause a decrease in sales revenue. Okay. Now, to continue, a firm could adopt more aggressive promotion strategies to market their product. Okay, so here they're talking about marketing, hence persuading customers to purchase their products. However, the business should be careful not to use expensive campaigns which will increase their costs. Okay, so they have to just make sure here. Okay. A business can reduce direct labor costs by ensuring that the staff are more productive and able to sell more units of a good produce. So basically, they're just gonna like work on productivity. However, the business should be careful not to demotivate or reduce the morale of staff. So here, it's just about marketing. Here it's marketing. Here it's HR. Okay, and always remember to mention the advantages, but then the disadvantages. We want both sides of the argument. Balance is key. Right. Now we have profit margin. So how do we calculate the profit margin? So the profit margin is basically profit before interest and tax divided by sales revenue times 100. Again, it is in percentage. So a high profit margin could indicate that the business is managing its expenses very well. So high profit margin meaning that managing its expenses very well. A low profit margin could indicate the business having difficulties in controlling overall costs. Okay. So high means they're doing well, low means they're doing badly, regarding their expenses and costs. So strategies to be improving profit margin include a firm can check its indirect costs and see to where its unnecessary costs can be avoiding. So basically they wanna end up overall cutting costs. Examples can be expensive holidays for senior managers, but it can demoralize managers who have been used to expensive holidays. So this may cause some resentment. It could cause a bad corporate culture. I guess it could negatively affect the corporate culture in the office, how things work. The second thing they can do is that the firm can negotiate with key stakeholders on cutting costs. So basically, they're both cutting costs, but in different ways. So basically, they could negotiate with the landlord to cut costs, but this may end up having them change their location. Once they change their location, then this can end up really negatively affecting the business. Why? Because they will end up having a different demographic. Their product might not be in demand in this location. They might not have as much traffic. They might not sell as much, so their sales revenue will decrease, thus decreasing their profit, right? So that's really it. Now for return on capital employed. So basically ROCE. ROCE, what does it do? It assesses the return of a firm from is making from its capital employed. So the return from capital employed. It measures profitability of a firm's invested capital. So how much money they make from their invested capital. So for example, machinery. ROCE analyzes how well a firm generates profits from their key sources of finance. Comparison should also be made of ROCE from past years together with those of other firms to get a better assessment of the firm. So here they just do comparison. We talked about comparison in the beginning, which is like it's a way for to use the ratios and analyze them and interpret them. So the formula is ROCE is profit before interest and tax divided by capital employed times 100. So again, keep in mind it's in percentage. Capital employed is basically non-current liabilities. What are non-current liabilities? They are liabilities that last for more than 12 months. So basically 1 year. What is equity? It's share capital and retained earnings. This is what equity is. So strategies to improve ROCE. So a firm should try to reduce the amount of long-term loans they take. So basically they want to reduce long-term liabilities, because once they reduce long-term liabilities or non-current liabilities, then they end up reducing capital employed. Once they reduce capital employed, then they end up increasing ROCE, right? This is what they end up doing. So yes, but they have to make sure that the interest and the and tax profit before interest and tax remains unchanged, so it does not decrease basically. The problem with this is that the business may need long-term loans to purchase fixed assets, so as machinery, which will aid in the further production of more goods that could generate more profit. Okay, so basically, A lot of businesses actually require funds in order to buy to buy a capital, because again, capital is really expensive. It's such as machinery, for example. A lot of businesses are new in the industry. They're starting out new in the industry. They are in need of loans in order to buy capital. They're not well sustained. They don't have high finances. They don't have high profit. So they actually need to buy it. So this is not the option. So basically, may not be feasible or an option for certain businesses, such as newer businesses, right? Okay. A firm could declare so basically that's why. Um, so for example, if they don't buy this new machinery, they're missing out on additional profit just because they're missing out on additional profit just because they could increase their sales revenue by selling more. So they increase the quantity they're selling. They end up making more sales revenue, so they end up increasing their profits, right? So they could be missing on that, right? If they don't invest in new machinery. Yeah, so capital. The second way is that a firm could declare and pay additional dividends to shareholders. So basically, this will have the effect of reducing retained profit and hence raising ROCE. So basically, when they pay the dividends to the shareholders, they end up decreasing retained earnings, because basically, what is equity equal to? Equity is equal to share capital plus retained earnings, right? So once retained earnings decrease, so will equity, and so will capital employed. Capital employed will decrease, hence our ROCE will decrease, right? So basically, the first option is basically decreasing non-current liabilities. The second option is decreasing equity. Yeah. So the fact of reducing retained profit and hence raising ROCE, assuming that the profit does before interest and tax does not change. However, reducing retained profit leads to less plucked back profit for future investment, right? So they won't have enough money to make future investments, maybe, right? So basically, the strategies for reducing ROCE, to sum it up for you guys, is basically they either end up reducing non-current liabilities, such as long-term loans, or they end up reducing retained earnings, because they want to reduce equity. Okay, so this is basically their options. This is what they can do. But for long-term loans, this might not be feasible for certain firms, especially new ones. Again, this depends on the context, the abilities of the firm. And the second one, ROCE, also depends on the firm. So now for liquidity ratios. So what are liquidity ratios? Liquidity ratio is the ratio that measures the ability of a firm to pay off its short-term debt obligations. Short-term debt obligations means that it's less than 12 months. Okay. Less than 1 year, in other words. Businesses need sufficient levels of liquid assets to help them pay their debt to their day-to-day bills. Sorry. Liquidity is a measure of how quickly an asset can be turned into cash. So this is the definition. This is very important. It's a definition. Liquid assets include cash, debtors, stock, cash being the most liquid, of course, which is why it's the first in the balance sheet. So if you want to learn about the balance sheet, then you can go to my video on 3.4, section 3.4, very important. Debtors and stock can be converted to cash, right? Because debtors is money that is owed to the business, so it's obviously easily converted to cash. And stock is basically tied up cash, because the business paid cash for the stock, right? It's basically tied up cash. Variation of current ratio and asset types need to be considered differently in different industries. So now we're going to begin. So the first type of liquidity ratio we have is the current ratio. It's a ratio that compares a firm's current assets to current liabilities. So basically, both of those, they're both short term, less than 12 months, right? A year. Basically, what are current assets? Cash, debtors, stock, current liabilities, short-term loans. Okay, so less than 12 months, and this is for both of them, right? So you end up dividing current assets by current liabilities, right? So this is how you do it. So Yeah. Recommended range for current ratios between 1.5 to 2, meaning that for every $2 of current liabilities, there's $1.5 of current assets. A ratio below 1 to 1 means that the current assets are less than the current liabilities, which could put the firm in financial difficulties when the firm is paying its creditors, right? Meaning that they have more liabilities than the actual assets they have, which could be sort of a problem, meaning that they have less cash than loans, so they have a hard time paying for their loans. Okay. Um, Basically, a high current ratio should be avoided. High current ratio should be because there is too much cash being held and not being invested. Okay, so too much cash, they're not being invested, so that's the problem. Too much stock is being held, thus leading to high storage cost. Again, high storage costs. So they're wasting money on this stock, and also they're paying storage like utilities for the storage, etc. Too many debtors, increasing the possibility of bad debts where they don't end up paying back. Um, so a firm could reduce basically, how can they improve current ratio? They could reduce bank overdrafts and get long-term loans instead. So basically, instead of short-term loans, they get long-term loans. So they end up decreasing current liabilities in order to decrease current ratios. That's the first way to do. So this will help reduce current liabilities, like I previously mentioned. So they end up reducing current liabilities. This improves the current ratio. Yet long-term loans may have a high interest. Okay. So this is like the negatives. They may have a high interest, and the gearing ratio will be affected, thereby affecting the efficiency and future liquidity position of the business. Again, you always have to show both perspective. Please always have a balanced argument. I'll write it again. Balanced argument. This is necessary in IB business management. Please, you guys, so you can get your full marks. The second point is that selling, so the second like way is selling long-term assets will increase cash, right? Increase cash. Thus increasing working capital for the business. However, the business may still need the assets, causing them to lease it, which can be costly. Okay, so basically they're saying to increase current assets, this will increase the current ratio. However, and what will happen is that sometimes they actually may need whatever they're selling. So they're going to end up needing something new, and they might end up losing money because of that. So they end up losing cash on the long run. So here talk about short run versus long run, right? That's what I've talked about. So basically, there's something you need to learn about all of these ratios, which is very, very important. If you didn't notice throughout my entire explanation, is basically every single way you have to use is through the equation, meaning that whatever components in the equation are either increased or decreased to end up manipulating the scenario, to end up manipulating the number, right? So what you need to do as a student is just know your formula, understand the nuances, and then you have to end up manipulating your formulas and your ratios in order to get to solving the issue, right? So now let us go to the acid test ratio. Okay, guys, so now for the acid test ratio, basically it's a stringent ratio that subtracts stock from current assets and compare this to the firm's current liabilities. So basically, they end up subtracting stock from current assets because what are current assets? So basically, current assets are made up of cash, debtors, and stock, right? But in this case, they end up just subtracting stock, right? So they end up just subtracting it. And then divided by current liabilities, which we both know they're both, like I previously mentioned, short term, less than 12 months. So the ratio indicates to creditors how much a firm's short-term debts can be met by selling its liquid assets in a short notice. Okay, so like I previously mentioned, stock is basically tied up cash. And they say in short notice, right? So how much they can pay in short notice, because selling stock, it takes time. Takes time to liquidate, right? And an asset ratio of less than 1 to 1 indicates that the business is not in sound financial health. So they are not in sound financial health. It could be facing a liquidity crisis, not being able to pay short-term debts because, again, there is no cash available. Okay, that is the problem. A high asset ratio, test ratio means too many debtors, so increasing possibility of bad debts. Bad debts, like I previously mentioned, their debts that are not paid. Basically, their debts that are not paid. Too much cash being held and not invested, so like lack of investment. This investment can be used instead in research and development. Okay, it can be it can be invested in expanding. So always when you talk about your 10 markers, you can also talk about how money can be invested and why it's actually a disadvantage to have too much cash. So again, you always need to think further in the IB, you always need to explain further. And again, the key, like I previously mentioned, is always having a balanced argument, you guys. It's very, very, very important to do so. So now, strategies to improve the asset test ratio. So a firm could sell stock, okay, at a discount for cash. It could sell stock. So they sell stock at a discount for cash, thus improving the liquidity of the business and making more working capital available. So basically, working capital is like the capital that you pay. So basically, you use this capital to pay for your to pay for your day-to-day expenses, to pay for short-term debts, basically. However, selling the stock at discounted price could reduce revenue generated from the stock, from the sold stock, hence reducing profit. Meaning that okay, that's a good thing, but it will end up like fixing our asset test ratio and improving it. But at the same time, we're selling these stock for a reduced amount, right? So we could be making more money out of it. So we end up losing money. We end up reducing profit because again, total revenue is price times quantity, right? So when price decreases, so does total revenue. And what is profit? Profit's basically total revenue minus total cost. So when we end up decreasing total revenue, we end up decreasing profit. So this is how it works. This is what I'm trying to explain. Okay, so this is what happens when you do a discount. Okay, this is what happened. A firm could increase the credit period for debtors, so the time for debtors to pay, to enable them to purchase or stock or on credit. So basically, they end up buying on credit, which will like make them buy more. The problem is that it may lead to an increase in bad debt if debtors do not pay. Okay, so basically, this is it, you guys. Thank you so much for watching. I hope you enjoyed this video. If you have any questions, please comment down below. Please subscribe and like so I can continue posting such videos. If you want to join my Google Classroom for IB Business Management, you can do so. The link is below. It doesn't have much content, but if you want content, I'll post on it. And if you want any private tutoring, you can also email me down below. Thank you so much for watching. Bye bye, guys.